Now, Norrenberger Asset Management expects the release of half-year results of corporates to shape investor sentiment, noting that strong corporate earnings and interim dividend declarations may bolster confidence and sustain demand for Nigeria equities. Pabina Yinkere, the Managing Director, Norrenberger Asset Management, joins me now for more on this discussion. Thank you so much for joining us on the show today, Pabina. Let's get into it. The market fundamentals definitely are different from what panned out a year ago. But for you, what are the highlights you've witnessed so far in terms of market movement, the direction we've seen so far in the first 6 months of this year?
Thank you for having me. I would say it's a rather resilient market performance because one would have expected that coming into a monetary policy cycle where interest rates, the monetary policy rate was at its peak, and interest rates are near historic highs, equity markets shouldn't have done as well. But I think it has shown that our market is very resilient. It has shown that investor expectation and investor thinking of how markets should be valued is correct, because as you can see, particularly the performance in the first half is more driven by fundamentals rather than speculation. So I would say the market has done very well, and part of this performance has been anchored in and around a recovery in sectors like the consumer goods sector, which is up 42% year to date. What's driving consumer goods sector, you would say? I think it is pretty much a recovery of earnings from the FX-related losses that many of them reported in 2024. We've also seen strong performance coming out from the banking sector as well as a result of strong Q1 earnings, and as well as successful recapitalization of many of the top-tier banks. So these are some of the highlights that have really driven the market in the first half of the year.
And talking about market drivers at this moment now, in terms of the reform space now, take, for example, the fiscal monetary authorities, the expectation of taking further reforms and initiatives. And when we are looking at the top players, consumer goods, banking, oil and gas, in terms of the different segment and representation, how much more shifts should we expect?
I think we should see an even stronger second half, because by the time we begin to see Q2 numbers, a lot of the FX-related losses would have been totally reversed by many of these consumer names. So I expect to see stronger corporate earnings coming out of the consumer goods sector, and that should pretty much drive market performance. We've seen the banks continue to post strong results, and as we know, high interest rate environments presents a chance for banks to increase their net interest margins. So I expect to see stronger numbers coming out of the banks as well. So I still think the second half of the year will be stronger than we have seen even in the first half.
And when we're looking at year-to-date returns as well now, it's quite a different picture we had last year, over 30%. Now we're still around that 11 range. For you now, when we're looking at market cap, when do you see us also getting back to that 100,000 mark?
One can't really say, but I think I mean 11% under the kind of economic and monetary policy environment we find ourselves, I would say is pretty strong, because you wouldn't expect that the market should have done as well or stay resilient like it has. So I think going into the second half, we should expect to see even more based on some of these things I've touched on. And there's another significant factor I haven't mentioned that I think is going to be particularly interesting to see how it plays out in the second half of the year. As we know, the pension fund administrators are the biggest set of investors in our market today. And the regulator, the National Pension Commission, is currently revising the investment guidelines for pension fund administrators that would allow a reduction in the allocation to FGN securities. What this means is that it presents a lot more allocation for other assets, including equities and private equity and infrastructure funds and the likes. By our calculations, we expect that if that action follows through and on a pro rata basis, it could release as much as 1.5 trillion naira of investable funds in other assets, which I think equities might get, a fair share of that new allocation. So there's still a lot more excitement to come into our markets in the second half of the year.
And talking about market excitement, we're also seeing the disinflation trend at this moment. But for you now, let's walk through the layered impact of the Central Bank of Nigeria's orthodoxy stance at this moment now. In the case of a sustained dovish stance with inflation still sticky, how do you see that also affecting, tilting investors' preference?
That would just double down the play on equity. As we know, there is an inverse relationship between fixed income and equity market performance. When interest rates are high, stocks don't tend to do too well. And when interest rates are low, the appeal for stocks become greater. So a reduction, a dovish stance by the Monetary Policy Committee would only just reinforce, the value that equities can bring going forward. So I think it'll be positive. Like you said, inflation trajectory is looking downward. The exchange rate stability, we've seen that most of this year. And those are key factors that go into the decision of the Monetary Policy Committee, whether to continue to keep a tight monetary policy environment or relax monetary policy. And I think the latter is the likely expectation going into the second half of the year. That will rub off positively on equities.
And we're looking at where we'd see inflation prints come Monday when the results, the data would come out. For you, where do you see inflation printing?
I think we'll see a mild improvement. We think we'll still hover in and around the 23% handle. And that's purely driven by the fact that in the last month, we've seen a more stable exchange rate, even some appreciation of the local currency. We've also seen that a reduction in fuel price across board by major suppliers. So I expect these factors to rub off on the inflation print for May. So a slight reduction, but I still think we'll be around the 23% handle.
Well, the presidency and his team is still optimistic that we can achieve that 15% inflation target. We're still waiting for the numbers from the Central Bank of Nigeria and further clarity on its inflation target and strategy. But we'll leave the conversation here for now. Thank you so much for your time on the show today. That was the Managing Director of Norrenberger Asset Management, Pabina Yinkere.